All right, let's get right into it. Welcome to today's Explainer, where we are putting PBF Energies squarely under the microscope. We're going to objectively unpack their physical footprint, dig deep into their frankly fascinating first quarter 2026 financials, and take a really hard look at their climate risk profile and transition strategies. If you track the energy sector, you know it's a space defined by massive scale, heavy physical realities, and intense transitional pressures. PBF is sitting right at the crossroads of all three. Here is our roadmap for today. We're starting with operations and business model, then moving right into Q1 financial performance, checking market sentiment, assessing climate and enterprise risks, and finally wrapping up with their future energy transition strategy. Okay, Section 1, Operations and Business Model. Look, before we even glance at a stock chart or valuation multiples, we have to ground ourselves in the sheer physical reality of what PBF Energy actually does day in and day out. So, looking at their 2026 projected throughput guidance, PBF is incredibly diversified across the US. I mean, they're moving serious volume here. We're talking 300,000 to 320,000 barrels per day on the East Coast alone, strong numbers in the Mid-Continent and Gulf Coast, and up to 300,000 on the West Coast. Add all that up, and the company's projecting a total throughput of up to 945,000 barrels per day. That is a massive logistical undertaking. But you know what's truly staggering? The infrastructure required to actually hit those numbers. PBF operates 6 domestic oil refineries, and while their projected throughput sits around 945,000 barrels, their maximum collective capacity is a massive 1 million barrels per day. That physical footprint gives them incredible leverage when crack spreads widen, but it obviously comes with immense overhead. And hey, it's not just how much oil they process, it's what kind of oil. PBF's refineries boast a weighted average Nelson Complexity Index, or NCI, of 12.8. Now, if you track refining, you know the NCI measures secondary conversion against primary distillation. A 12.8, that is highly advanced. It literally means they have the complex operations needed to take cheaper, heavier, sour crudes and turn them into high-value stuff like ultra-low sulfur diesel and jet fuel. Moving right along to Section 2, Q1 financial performance. Let's pop the hood and see how those millions of physical barrels translate into actual dollars and cents. Now, this is where you really need a trained eye. At first glance, the headline looks incredible. Q1 2026 GAAP net income of $202.2 million, or $1.65 a share. But when you strip away the special items and non-cash accounting noise, PBF actually reported an adjusted, fully converted loss of $102.4 million, so negative 88 cents a share. Why the huge gap? Well, it mainly comes down to major planned maintenance turnarounds that temporarily choked off their capacity, plus some transitional operations over at their Martinez facility. However, and this is a big however, their liquidity got a massive, completely separate boost, $1 billion. That's the total insurance proceeds PBF has pulled in so far related to the 2025 fire at the Martinez refinery. In Q1 alone, they grabbed a fourth unallocated installment of $106.5 million. That cash influx has been an absolute lifeline while the facility rebuilds and gets back on its feet. So, where does that leave the balance sheet? PBF ended the quarter carrying a market cap of roughly $4.85 billion. They're sitting on about $542 million in cash, against a net debt load of $2.3 billion. In the heavy, capital-intensive world of refining, managing that kind of leverage while still funneling cash into turnarounds and environmental compliance, it is a constant tightrope walk. So the crucial question is, how does management treat shareholders while walking that tightrope? Well, despite the adjusted operational loss for the quarter, PBF held firm on returning capital. They declared a 27.5-cent quarterly dividend. At current market pricing, you're looking at roughly a 2.7% yield. Honestly, it's a massive signal from management that they view these Q1 operational headwinds as strictly temporary. All right, Section 3, Market and Sentiment Indicators. We know the operations, we know the balance sheet, but how is Wall Street digesting all of this? We pulled some sentiment data from Quiver Quantitative, and it paints a pretty mixed, maybe even cautious picture. Look at this, 45 insider sales over the last 6 months and 0 insider buys. Institutional flow is totally split, with 175 funds buying, but 198 decreasing their positions. On top of that, the median analyst price target sits at $36, which is actually a bit below where the stock has been trading lately. But here's where it gets interesting. Despite that heavy insider selling, the stock actually jumped over 6% recently. Why?
because the market is gaining confidence. Margins are improving, and management confirmed the Martinez facility is successfully working through its sequenced restart, targeting full plant production by early May. For an independent refiner, getting a major down facility back online is huge catalyst. Which brings us to Section 4, Climate and Enterprise Risks. Because beyond the quarterly margins, PBF faces some very real, existential industry pressures. We're sourcing this analysis directly from their inaugural 2025 Task Force on Climate-Related Financial Disclosures, or TCFD, report. Their scenario planning here brilliantly illustrates how they're charting the risk horizon. Looking at a fossil fuel development scenario, they've clearly mapped out the threats. Short term, they're fighting acute, severe weather and the immediate financial sting of rising carbon prices, and RINs, those renewable identification numbers they're forced to buy. Medium term, they're flagging water scarcity, which is critical in places like California, plus emerging legal risks. And long term, they are bracing for chronic temperature changes and the ultimate market risk, asset stranding, if fossil fuel demand simply falls off a cliff. Let's take that abstract risk and make it completely concrete. Severe weather isn't just an environmental concern, it's a direct, literal threat to the bottom line. Hurricanes, tornadoes, extreme cold snaps, these events can physically tear apart massive facilities. We're talking catastrophic equipment failures, disrupted pipelines, and complete operational shutdowns that torch revenue. But PBF isn't just sitting around crossing their fingers. They have a highly systematic, localized approach. Just look at their Hurricane Advisory Committee protocol. They review strategies way ahead of time. A week out from a storm, they're actively filling tanks and locking down assets. 4 days out, they're running precise decision guides to evaluate full facility shutdowns. And post-storm, it's an immediate pivot to damage assessment. It is a rigid playbook explicitly designed to protect their people and their billion-dollar assets. And that risk mitigation? It goes straight to the top. P&G set up a sustainability executive committee that reports these exact climate risks and opportunities to the board of directors at least quarterly. So the board is actively weaving these environmental and physical realities right into their fundamental financial strategy. Finally, Section 5, Future Energy Transition. Knowing all those risks, how exactly is PBF gearing up for the future? Well, their strategy revolves around exploring new product lines without buying up massive, burdensome new assets. A prime example here is their involvement in the Mach2 initiative. This is a massive consortium that landed up to $750 million in Department of Energy funding to build a clean hydrogen hub. PBF is using 2,500 acres right next to their existing Delaware City refinery to explore green hydrogen production, renewable electricity, and even fueling stations for medium-duty trucks. They are literally using their existing geography to tap into next-generation energy. They are doing something very similar down south. They hold a 50% interest in a renewable diesel facility co-located right at their Chalmette refinery in Louisiana, teaming up with Enalive. By slapping this biorefinery right next door, PBF builds a critical alternative revenue stream that acts like a financial buffer against traditional crude supply shocks and increasingly strict government emissions mandates. Which brings us to the ultimate question we have to ask as we wrap up this explainer. Can PBF Energy effectively balance the massive capital demands of a traditional 1 million barrel a day refining empire with the unavoidable long-term realities of the energy transition? Are co-located biorefineries and hydrogen hubs really enough, or will physical and regulatory risks eventually outpace them? It's a fascinating strategic pivot to watch, and one that is absolutely going to define this company's valuation for the next decade. Thank you so much for joining me for this deep dive. Keep learning, and I'll see you in the next explainer.